So now we come to impairment of our planned assets. What if our planned assets are not going to provide us the amount of future economic benefit we thought they might? Think Boeing lately with their nice airplanes that tend to crash. We're talking about impairments. So when inventory drops in value, we report it at lower of cost or net realizable value or lower of cost or market in certain circumstances, but that doesn't apply to our property, plant, and equipment. So when the carrying value of a plant asset is what they call no longer recoverable, in other words, if we're not going to be able to use it for as long as we expected, or it's dropped in value for some other reason, we have to write down the asset. So I give some examples in the notes of various impairments that happened as a result of Hurricane Katrina down in New Orleans. You had exhibit halls that were damaged severely, and those were assets that obviously were not going to provide the future economic benefit that was expected. Same for Smith and Walensky restaurants down there. So anyway, there's going to be a bunch of reasons for impairment. It doesn't have to be that your planes crash. It could be a decrease in the market value of the asset, change in how the asset is used. You could be not going to be using it. You might be using it less. You might be using it in a different way. The legal or business climate could change. And there's various other, maybe there's legislative or other legal problems. So anyway, impairment. We have to figure out how to account for this, and what you want to keep in mind is the basic principle. An asset's supposed to provide a certain amount of future economic benefit. If it's not going to do that, we cannot overvalue it on our balance sheet. So we have to record what are called impairment losses. Now, there's a fairly complicated process for going through this, but fortunately, I kind of work it through on a step-by-step basis, so it might not be that bad. So when the first thing you do when you think that you might have an asset that is impaired is we do what's called the recoverability test. So you look at the estimated future net cash flows from the use of the asset, undiscounted, and those will be given to you in the book. I don't believe you have to calculate those at this point. And then you compare them with the carrying value, okay? Cost less accumulated depreciation to date is your carrying value. If your carrying value is greater than the expected future cash flows, you've got some impairment. Okay, that's step one. Step two, if it is impaired, then you calculate the impairment loss. And to do that, you need the carrying value again, but then it's compared to the fair market value of the asset to get you the impairment loss. Okay? Fair market value if there's an active market, or you use the present value. In other words, you're getting into the discounted future net cash flows. Okay, so you get your two steps so far, recoverability and then compute the loss. Then you make the journal entry, and it's going to be your loss on impairment for whatever amount it comes out to, and you're going to credit your accumulated depreciation. So then you have to ask, are you going to keep using the asset? If you are, it's going to be treated one way. If you're not going to keep it, if you're going to sell it or dispose of it, it's going to be treated another way in the accounting. So if you plan to keep it, your loss is going to be under your other expenses and losses on the income statement, part of income from continuing operations, even though you're, because you're going to keep it. You have to disclose what impairment happened, the events, the amount of the loss, and any calculations you use to determine your numbers on it. Okay, so that's if you're planning to keep it. It would also continue to get depreciated, but based on the new carrying value and new estimates of depreciation. If you are planning to dispose of the impaired asset, let's see, I need a little space there, this means you're not going to use it anymore, and so it would not get depreciated anymore. It would be held for sale, more like you had inventory. And so You're going to value it at the cost or the net realizable value, whichever is lower. Your net realizable value being the fair value less whatever selling costs you have. Okay, so no depreciation. In each period it's held, you record at the lower of cost or net realizable value. And you can write it up or down as long as it's held for disposal, but the carrying value after the write-up can't be more than the carrying value before the impairment. You got all that? Yeah, it takes a little bit. Okay, so this is, all right. So I think that I'll let you sort of think about the basics of that, and then in a separate video, I will go through an example with my, I don't know how many steps it has, but I have a step-by-step process to take you through this.